Benjamin Graham on Investing, Enduring Lessons from the Father of Value Investing, is a compilation of the investment strategies and philosophies of Benjamin Graham, who is widely known as the father of value investing. The book provides a deep dive into Graham's approach to the stock market, emphasizing long term, fundamental analysis over short term speculation. Here's our pick of the top 10 insights from the book. 1. Investing is most intelligent when it is most businesslike. The gem dropped by Benjamin Graham, that investing is smartest when it's akin to running a lemonade stand, is essentially finance's keep it real mantra. Graham's savviness whispers, "Hey, Wall Street, grab your apron, not just your calculator." When you choose stocks like you're stacking oranges in your market stall, ensuring they're fresh and priced right, you're onto something. Don't just tickle the keys of your Bloomberg terminal. Imagine you're having to sell your investments to actual humans in a corner shop. Those bargain bin stocks? They're like day-old donuts, easy on the wallet, but study their shelf life. Applying good old-fashioned business sense, diligence, and a touch of street smarts, you'll not only be a savvy investor, but possibly the Warren Buffett of your neighborhood bake sale. 2. The market is a voting machine in the short run, but a weighing machine in the long run. The tumultuous love affair between Mr. Market and his mood swings. Graham's insight here is vintage Wall Street wisdom, reminding us that daily market fluctuations are more akin to a popularity contest rather than a sober assessment of value. In the short term, it's all about who's hot and who's not. But as time marches on, the market starts to diet on reality, and the true substance or lack thereof of investments come to the fore. So, while the market might swipe right on some flashy stocks today, it's the solid, dependable types with real value that win its heart in the end. Keep calm and invest on, knowing that in the financial beauty pageant, substance triumphs over style when the final roses are handed out. 3. The future value of every investment is a function of its present price. Picture yourself at an antique auction, eyeing a dusty old lamp. The opening bid is a mere $10, but you've got that hunch it's a genie's vacation home. You know that if you snag it at a bargain, the future payoff could be your very own financial three wishes scenario. Similarly, Ben Graham teaches us to hunt for those undervalued market relics. The lower the price you pay now, the higher your potential profit. It forces us to put on our financial detective hats and search for clues of undervalued assets, always remembering a penny saved on purchase is a potential dollar earned in the future. So, next time you spot a stock at a price that seems like a market typo, tip your hat to Mr. Graham. It might just be your portfolio's magic lamp. E4. The defensive investor should focus on quality and proper diversification. A defensive investor is much like a culinary novice in a kitchen. They'll fare best sticking to a tried-and-true recipe for success. This means selecting the creme de la creme of stocks, the blue-chip ingredients, if you will, rather than speculative penny stocks that can spoil the broth. But don't just hoard all the cheese. Proper diversification is like a well-balanced diet. It ensures you get all your financial nutrients without overindulging in any one sector's flavor of the month. In Graham's gourmet investing advice, blending quality with variety doesn't just spice up the portfolio, it also cooks up a robust defense against the market's fiery temperament. Bon appetit, dear investor. 5. True investment requires a thorough analysis that promises safety of principle and an adequate return. The sagacious Mr. Graham, financial Yoda that he was, imparted a nugget of wisdom we ought not to ignore. Treat investing like a Michelin star chef treats a recipe, with precision, care, and a sprinkle of skepticism. Just as you wouldn't throw random ingredients into a pot and expect a gourmet meal, you shouldn't toss your cash into stocks willy-nilly and expect a fortune. Graham urges us to slice and dice those financial statements like a culinary master, guaranteeing that our principal isn't the sacrificial lamb and our returns aren't just the side salad, but the juicy, succulent main course. Only then does investing transcend speculation and become a Michelin-worthy concoction of financial delight. 6. Market fluctuations can be exploited by the wise but will ensnare the unwise. Picture the stock market as a manic depressive acquaintance named Mr. Market. On good days, he offers sky-high prices for your share of a business, and on bad days, he'll sell you his for peanuts. Wise investors know this emotional roller coaster is a ticket to profit if they keep cool, while the unwise get ensnared, buying high out of greed and selling low in panic. The sages amongst us exploit these swings. They buy when Mr. Market is deep in despair and sell to him when he's on a euphoric upswing. It's a bit like shopping at your favorite store. Why pay full price when the sale season is just around the corner? 7. The distinction between investment and speculation is critical to proper decision making. Let's slice through the murky waters of the financial world with the precision of Graham's wisdom, shall we? Investing is like having a great recipe for grandma's lasagna. You gather quality ingredients, stocks, mix them at the right proportion, portfolio diversification, and give it time to cook to perfection, long-term growth. Speculation, on the other hand, is akin to throwing random ingredients into a pot and hoping it tastes like something from a Michelin-starred restaurant. It's a financial food fight with your money. Graham's golden nugget of know-how reminds us, to feast on the fruits of our investments tomorrow, we must plant the seeds of wisdom today, not gamble them away on the winds of chance. 8. Investing in a mediocre business at a great price is better than a great business at a mediocre price. Imagine sauntering into a gourmet pizza joint with the world's finest toppings on display. There's the great business pizza with exquisite ingredients, but at a price that'll have your wallet running for the hills. Right beside it is the mediocre business pizza, looking modest but tagged with a price so low, it's practically begging you to take a slice. Benjamin Graham, the investing maestro, would nudge you towards the second option. Why? Because when the dough settles, it's the slice you snagged for a steal that fills you up without emptying your pockets. You see, when it comes to investing, it's all about getting more bang for your buck, or in this case, more pizza for your penny. 9. Emotional discipline is paramount, as fear and greed are investors' worst enemies. Oh, the fickle human heart, pumping not just blood, but also a cocktail of emotions, notorious for leading even the shrewdest investor astray. Old Benny Graham wasn't just whistling Dixie when he zeroed in on emotional discipline as the cornerstone of investing sagacity. Think about it. Markets swing like a pendulum between the haunted house of investor fears and the candy store of their greed. Developing an emotional Spock-like shield is crucial. Otherwise, dreams of smart investments will be as fleeting as your commitment to a New Year's resolution. So keep a Vulcan grip on your emotions, because the market is more bipolar than a weather forecast in April. Only by mastering the art of investing aloofness can one truly thrive amidst the irrational exuberance and doomsaying that populates Wall Street's tumultuous opera house. 10. Margin of safety is the central concept that underpins a conservative investment approach. Imagine you're a trapeze artist, but with a savvy investor's mindset. Rather than swinging wildly, you've got a sturdy net below. That's the margin of safety. It's your financial cushion that Benjamin Graham, the grandmaster of not losing your shirt, insists on. It's buying $1 for 50 cents and smirking when the market sneezes because your investments won't catch a cold. Graham's wisdom is simple. Cheap assets can fall, sure, but not far from the bargain basement. So, the next time you're eyeing up a stock, think like a discount shopper with acrophobia. Aim for a deal with plenty of room below, just in case. To sum it up, Benjamin Graham on investing, enduring lessons from the father of value investing, imparts the wisdom of approaching investments with a business mindset, emphasizing thorough analysis for safety of principal and adequate returns, and the importance of emotional discipline to leverage market fluctuations. It distinguishes between investment and speculation and champions the margin of safety as the cornerstone of a prudent investment strategy. Thanks for watching, and may your investments reflect the lessons from the father of value investing.